Hello, Money Minds. Welcome back to our channel. Today we're diving into the world of investing, guided by none other than the Oracle of Omaha himself, Mr. Warren Buffett. This titan of finance, a self-made billionaire, is renowned for his savvy investment strategies and his uncanny ability to turn a profit. He's not just a businessman, he's a legend. And today, we're going to learn from the best. We're uncovering the 3 simple rules that Buffett himself follows when investing. These aren't complex strategies known only to Wall Street insiders. No, these are straightforward common-sense rules that anyone, yes, even you, can understand and apply. We're going to discuss investing in what you know, why timing the market isn't as important as time in the market, and the power of diversification. These principles are the bedrock of Buffett's approach to investing. So if you're looking to start investing or simply want to improve your strategies, stay tuned, this video is for you. Rule number 1, invest in what you know. This is a principle that has guided the investment strategies of some of the world's most successful investors, including the Oracle of Omaha himself, Warren Buffett. When you invest in industries and companies that you're familiar with, you're not just throwing your money into the abyss and hoping for the best. You're making an informed decision based on your knowledge and understanding of that particular business or sector. This, in turn, can significantly lower your investment risks. Let's take a look at Warren Buffett's portfolio, for instance. You'll notice that a significant portion of his investments are in companies like Coca-Cola and Apple. These are companies that produce goods and services that are used by millions of people every day. They operate in industries that are easy to understand, and their business models are straightforward. Why Coca-Cola and Apple, you might ask? Well, Buffett understands these businesses, he knows how they make money, and he has faith in their long-term prospects. He didn't invest in these companies because of some hot stock tip, or because he thought their stock prices would skyrocket overnight. He invested in them because he understood their businesses and believed in their potential for long-term growth. Now, this doesn't mean that you should only invest in companies that produce products or services that you use personally, but it does mean that you should make an effort to understand the businesses you invest in. What does the company do? How does it make money? What are its long-term prospects? What are the risks involved? These are the sorts of questions you should be able to answer before you decide to invest in a company. Remember, investing isn't about making a quick buck. It's about putting your money into businesses that you believe have the potential for long-term growth. And understanding these businesses is the first step towards making informed investment decisions. As Warren Buffett once said, an investor needs to do very few things right as long as he or she avoids big mistakes. So make sure you're investing in what you know, and you'll be well on your way to avoiding those big mistakes. Moving on to rule number 2. Don't try to time the market. This might seem like a puzzling concept, especially to those new to the world of investing. The idea of buying low and selling high seems to be the most rational approach. However, the reality is far more complex. Market timing is the strategy of making buy or sell decisions by attempting to predict future price movements. The aim is to buy at the lowest point and sell at the highest. Sounds easy, right? Well, not quite. The problem lies in the unpredictability of the market. It's virtually impossible to consistently predict these peaks and valleys. You see, financial markets are influenced by numerous factors, including economic data, geopolitical events, and even investor sentiment. It's a volatile dance of numbers that no one can accurately forecast all the time. In fact, even seasoned investors and financial experts often get it wrong. This is where Warren Buffett's wisdom comes in. He famously stated, "Time in the market is better than timing the market." What he meant is that the longer you stay invested, the more potential your money has to grow. This is due to the power of compound interest, which can significantly increase your wealth over time. Instead of trying to catch the market's highs and lows, Buffett advises focusing on the long-term prospects of your investments. This means investing in companies that you believe have sustainable growth potential, and holding on to those investments through the market's inevitable ups and downs. So, if you find yourself tempted to play the timing game, remember that even the pros often strike out. Instead, focus on the quality of your investments and let time do its work. After all, investing is not a sprint, it's a marathon. Remember, it's not about when to invest, but how long you stay invested. And last but not least, rule number 3, diversify your portfolio. Now, if you've been around the investment block, you've probably heard the term diversification a lot. But what does it really mean? Well, in simple terms, diversification is about spreading your investments across different assets to reduce risk. It's like the old saying, don't put all your eggs in one basket. Imagine you're at a buffet. You wouldn't just fill your plate with only one type of food, would you? No, you'd want to try a little bit of everything. That's what diversification is all about. You spread your investments across different sectors, industries, and even geographical locations. This way, if one area underperforms, it doesn't spell doom for your entire portfolio. But don't just take my word for it, let's take a look at Warren Buffett himself. His firm, Berkshire Hathaway, is a prime example of a diversified portfolio. From insurance to utilities to consumer goods and even technology, Buffett has dipped his fingers into numerous pies. And why? Because he understands the importance of not putting all his eggs in one basket. Yet, it's crucial to note, diversification isn't about blindly throwing your money at every opportunity that comes your way. It's about thoughtful, informed investment in a variety of sectors and industries that you understand and believe in. Remember rule number 1? It's all about investing in what you know. And that rule still applies here. Buffett didn't diversify into industries he knew nothing about. He did his homework, understood the businesses, and then made his move. So, as you embark on your investment journey, remember to diversify your portfolio. Spread your investments across different assets that you understand and have confidence in. This way you can protect yourself from significant losses if one investment underperforms. In the words of Buffett himself, do not put all eggs in one basket. It's a simple rule, but one that holds the key to successful long-term investing. Now that we've covered the 3 simple rules of investing, let's wrap things up. Investing can seem like a daunting task, but as we've seen today, it doesn't have to be. The principles are simple and straightforward, and they can be broken down into 3 easy-to-remember rules. Firstly, we talked about the importance of investing in what you know. Warren Buffett himself has mentioned that he only invests in companies he understands. This is because understanding a company or industry allows you to make informed decisions and avoid potential risks. It's about staying in your lane, not getting swayed by the latest trends or the hottest stocks. If you don't understand it, don't invest in it. It's as simple as that. Next, we discussed the futility of trying to time the market. As Buffett famously said, time in the market is better than timing the market. Predicting short-term market fluctuations is a fool's game. The focus should be on long-term prospects. Investing should be viewed as a marathon, not a sprint. It's about patience, persistence, and the power of compound interest. So remember, don't try to beat the clock. Let time work for you. Lastly, we emphasize the importance of diversification. Spreading your investments across different assets can reduce risk. It's like not putting all your eggs in one basket. If one investment underperforms, your other investments can help cushion the blow. Diversification is about balance and protection. It's about creating a portfolio that can weather the storms and deliver consistent returns over time. In conclusion, investing is not about getting rich quick. It's about creating wealth over time. It's about understanding what you're investing in, being patient, and spreading your risk. These 3 rules, while simple, form the cornerstone of successful investing. They are the guiding principles that have helped Warren Buffett become one of the most successful investors in the world. But remember, these rules are just a starting point. Investing requires continuous learning and adaptation. The financial market is dynamic, and so should be your investment strategy. Always be open to learning, be curious, and never stop asking questions. Thank you for watching Money Minds. We hope that these rules have provided you with a solid foundation to start your investing journey. Apply them, adapt them, and most importantly, believe in them. And remember, the best time to start investing was yesterday. The second best time is now. Don't forget to subscribe to our channel for more investment tips and advice. Your journey to financial freedom starts here. Until next time, happy investing.